Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, January 11th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we've got futures rallying off of the nice reversal that we saw on Monday. So good news there. Let's take a look and see exactly where we are on those futures. Currently, I'm showing the Dow Jones futures up 70, S&P 500 futures up 15, NASDAQ futures up 74. So seeing a little bit more relative strength there. On a percentage basis, that pegs the NASDAQ at about just under 0.5% higher, while the S&P 500 up about 0.3%, the Dow up about 0.2%. Crude oil prices are up this morning to about $79.50 per barrel. That's 1.6% higher. Meanwhile, the 10-year Treasury yield has cooled off a little bit. We got up over 1.81 or 1.80% recently, but we are seeing a drop this morning, down about 2 basis points to 1.76%. I think it's the spike in interest rates and the fear of inflation that has really driven a lot of growth stocks lower. We did see a nice rally, however, midday on Monday, and a rally all the way through the close. So it looks like the bulls are at least trying to put a floor in here near term. The one big problem we're going to have with that, though, is that we've got the next CPI report coming out on Wednesday morning. So it'll be interesting to see if maybe all the bad news has already been built in. So maybe we continue a relief rally with the report tomorrow. Or the other possibility, of course, is that the higher inflation rate spooks these growth investors once again. So going to be a very interesting week for sure. A lot of selling recently, the big bounce back yesterday. Now we'll see where we go today. Before we get into all the action, let me just go ahead and go through today's agenda with you. We'll start off with the daily market recap. Then we'll get into talking technically, where I'll look at a lot of these reversals from yesterday. Do a quick commodity outlook. Then earnings spotlight. The banks open up kickoff earnings season this Friday. So got some interesting charts we'll look at there, and then we'll wrap up with the 3 you must see. Before we get into any of that, though, let me take you over to Earnings Beats. If you're new to Earnings Beats, I always like to start the show off with just an invitation for you to join our Earnings Beats Digest newsletter. This is probably the best way to really get to know us, how we evaluate stocks and so forth. It's a 3 times a week newsletter on Mondays, Wednesdays, and Fridays. Normally newsletters out by about 8:30 in the morning. And it's a very quick read. Couple paragraphs and a chart is what we shoot for. So it's a quick way to get a better understanding maybe of some of the things that we do. It could be providing trading opportunities. That's completely up to you. But I normally will take a look at a chart and point out relative strength or maybe accumulation distribution, those sorts of things. Maybe it's a big candlestick that could be maybe confirming a breakout or maybe signaling a reversal, those types of things. But I do a lot with earnings, as you can imagine from our name. We do look fundamentally at companies, and then we look at the technicals for actual entry into a stock or for the sale of a stock. Anyhow, all you need to do to subscribe for this is type in your name, email address, hit that subscribe button. It's completely free, 100%, no credit card required, and you can unsubscribe at any time. All right, let's jump into the daily market recap for Monday. And the Dow Jones Industrial Average finished down 162 points, but it was down a lot more than that earlier in the session. Probably down 500-600. I don't remember exactly how low it got, but it was down quite a bit earlier in the session. The S&P 500 down 7 points, but it had moved all the way down below 4,600, as you can see, and we closed at 4,670. So really, really big reversal there, and you can see that trend line that held. So we do have a channel still working. I'm not sure we're completely out of the woods in the short term just yet. However, that reversal was better than the alternative. The NASDAQ finished up 7 points. Look at the huge drop here. We were down near 14.5, came back up, finished at 14,942, almost back to 15,000. The good news is we rallied. The bad news is we just got back to the breakout level. So are we going to just start off kind of strong this morning and then sell off because we're just going back up to test the breakdown? Could we get back up to that 20-day, that declining 20-day? I certainly think that's a possibility. That would be at 15,400. But it's hard for me to imagine there's going to be a lot of interest in growth stocks and some of the high flyers we find on the NASDAQ heading into that CPI report tomorrow. I could be wrong, but it's not something I would be doing, with a whole lot of enthusiasm. Mid caps finished down 11 points, but like the other major indices off of earlier lows, big reversal. Same with the small caps finishing down just 5 points after being down much more earlier in the session. As I look across at the AD lines on the major indices, I'm not liking what I see on the Dow. You can see we put in new highs, but we didn't with the AD line. I'm not with the S&P for the same reason. Higher prices, couldn't get that breakout. However, NASDAQ shares, even though they've performed worse in the near term, they actually made a breakout on the AD line with prices going lower. So it kind of fits in with my theory that I don't believe inflation is a problem longer term. I think it's a problem near term. Obviously, the numbers, certainly bear me out on that. But I don't think this is something that's going to stick around. As I talked about on Saturday at our Market Vision 2022 event, there's just too many signals suggesting that this inflation-led sell-off, if you will, is not going to be here for very long. Wall Street's not buying into it. And I would say this is one piece of evidence that would suggest just that. We've got these growth stocks really getting hit hard these last couple of months. NASDAQ was over 16,000. We got down almost to 14.5 yesterday. That's almost a 10% pullback. That qualifies as a correction. And yet the AD line keeps moving higher. It makes you wonder. Anyhow, healthcare, the best performing sector on the reversal that we saw on Monday, finishing up 1%. So a pretty strong day for healthcare stocks. Technology finished higher by just 0.02%. So you might say, big deal. Well, it was a big deal because earlier you can see clearly we were breaking down below the December lows, that double bottom that we saw around 163, 164. We were down well below that intraday and came back up. So while you might look at the percentage gain and just say, well, it really wasn't that big a deal, technically on the chart, that was a big deal. That was a big reversal to at least hold on to support in the short term. I would expect at a minimum a quick bounce. Maybe it's just this morning, maybe it's a day, maybe it's several days. Maybe, we've built in this weak CPI report and the rising inflation number that's sure to come tomorrow morning. Maybe that's built in the near term with this big decline. And maybe the market will be okay in the very near term. We're going to find out, though, here, not just today, but throughout the week. Industrials, however, were the worst performer, down 1.13%. Went down, tested the 50-day, bounced off of it. That's good. Looking down at that AD line, not good. Materials recently broke out, pulled back, held the 50-day, very similar to the industrials. AD line, a multi-month low, not good. Consumer staples, I do think that this one is an area that the market has been accumulating. And honestly, that's not great action because we don't want defensive groups leading the market to the upside. And I think it's pretty clear when you look at the S&P 500, the breakout that we saw in December, well, one of the main groups that led that rally was consumer staples. And that doesn't make me feel good at all. Now, the AD line's strong. If I wanted to trade on the long side, I know, technology and consumer discretionary offers up some very fast movers. But if you're trying to manage risk, it's really hard to do with many of those growth stocks, you might want to take a look at some of the staple stocks on this pullback because they don't move as fast. They do help, mitigate a lot of the risk that's associated with those high growth stocks. And so it's just a more conservative way of trading the market if you still want to be in the market. So something that I would consider. All right, 10-year Treasury yield. So economic reports, really nothing today. Tomorrow, Wednesday, is going to be the big day. We have the December CPI coming up. The estimate for the core CPI is to rise 0.5%. Now, keep in mind, the annual number is not only based on the December number, being added to the prior annual number, but also the December 2021, or excuse me, December 2020 number comes out of that calculation. Well, December 2020, the CPI, core CPI, was 0. So that's not going to help lower inflation at all. When you pull out 0 from 5.4, you're still, or from 4.9, which is where we were, that still leaves you at 4.9. So whatever we come up with today or tomorrow in the December CPI, core CPI, that's what's going to get added. So the estimate is 0.5%. That would take us from 4.96 up to 5.46 if that number is true. But if it's higher than expected, obviously that annual core rate will be higher than the 5.4. And if we come in a little less, then maybe we get a number that'll come in a little bit below that 5.4. Either way, though, I do expect we're going to see that annual core inflation rate rise again. And that is going to spark headlines, and it just makes me nervous here in the near term and even further out, because as we go through with these next couple of CPI reports, we're going to have the same issue. January and February, I think, were flat and up 0.1% core inflation. So as we add the next 2 months, we're going to see that annual core CPI rate go up, probably above 6% and possibly up to maybe 7%. That could be in the cards over the next few months. That would be the highest level of core CPI since back 1983. All right, let's look at, one other thing to mention here with the 10-year Treasury yield is this is the breakout. So we got above this 175 area. I think we could run to 190, 195, something like that. That's what I'd be looking for. And that comes from looking at a longer term 5-year chart. You can see the highs right here back in March of 2021, where we got up to about 175. If you go back below or before that and look at the end of 2019, pre-pandemic, there's that 195 reaction high. So we were going down and then we rallied back to 195 before we fell apart. So now we came up, we printed a high at 175, sideways consolidated. Now we're through the 175. If inflation continues to be a problem and the Fed continues to talk about raising rates, it wouldn't be at all a surprise to see the 10-year Treasury yield move up to about that 195 level. Now, if it does, higher interest rates do take away from the valuation of growth stocks. Now, if the growth stocks if their growth rates continue to improve and accelerate, it can offset those interest rates. But just know, anytime you have interest rates on the rise, that is a headwind for growth stocks, and we could see a little bit more of that in the near term, just based on the chart, based on this breakout, and based on the next area of resistance. Clearly, a break above 1.95% is something that we're going to have to deal with if it happens. And then potentially, if we truly are stuck with this higher inflation for a longer period of time in 2022 than I'm expecting, I would not be shocked to see the interest rate go higher, possibly as high as 3.25% to test the 2018 high. Now, for me, you got to look at the big picture. And the big picture, if you look at the monthly chart on the 10-year Treasury yield, and we'll go back, 40 years. I mean, 3.25% right now seems like, oh my gosh, it would be horrible. But that would just be back where we were in 2018. It would still be way below what we've had over the last 40 years. And we've had some really strong bull markets with interest rates well above 3%. If you look the late 1990s, we were seeing tremendous movement down in the yields, but we were still, even at this low right here, at 4%. And in 1999, when we had a huge rally in the market, we saw a spike all the way up near 7%. So don't think that if we go above 2%, that it's going to absolutely crush the stock market. I don't think so at all. In fact, I do believe our bottom is in on the 10-year Treasury yield. And I think slowly we'll probably make our way back to that 3-4% level to normalize, the bond market a little bit more. But I don't think that's going to coincide with a major sell-off in the stock market over time. Short term, yes, I do think that there's a heightened risk right now, first half of 2022, for a lot of the reasons I discussed at Market Vision 2022. But further out, I don't believe that we're going to see a huge sell-off. I'm not expecting the 2 to 3 year bear market. That's what I'm trying to say. I think 3 to 6 months, we could have some issues in the stock market. After that, I see much higher equity prices. I see the S&P 500 going much higher. So it's just like this bridge, in my opinion. We need to get through these first 6 months of 2022 and see what kind of damage we might find technically. And then I think we'll be primed for a recovery off of that. Let's move on to talking technically. So let's take a look at the S&P 500. So there was your big move down. That was a nice hammer that printed. Now we do still have a series of 5 straight days where we have been down. So even yesterday, the S&P, we had the big reversal, but we still did finish lower. And that was the 5th consecutive day of losses on the S&P 500. If we do rally back up, the question I'm going to have is, can we get through that 20-day? Because if this is truly starting a downtrend, which the last 2 did not, we went down, we went right back through the 20. That tells me we're kind of in a directionless market, sideways consolidation. We went down below the 20 and the 50 again, came right back up through it. Once again, that tells me that we are not trending lower. Instead, we're going sideways. Now, the last breakout, I'm not a big fan of because of the leadership that we saw and the negative divergence on the weekly chart that just will not go away right here. The PPO has continued to drop with every high on the S&P 500 since May. There was your top in May. Every single high since then, we have seen a lower PPO. So we bounced nicely off the 20-week EMA yesterday. Can we continue to hold it? Well, I think some of that is going to depend on whether we can get back through the 20-day EMA, which is at 4708. So watch that number. My gut feeling is we don't get through it, and we fall back down and go to new lows. But hey, the bulls, it's been a very, very resilient, set of bulls over the last, 21 months, all the way back to March, April 2020 during the pandemic. So, it's hard to bet against the group, but at the same time, there's so many warning signs. It's hard to bet on the group. So it's going to, like I said, going to be a very interesting week ahead, and really next few months, in my opinion. All right, next up, let's take a look at the NDX, the NASDAQ 100, because this is where a lot of those technology names live, and was the big reversal we saw yesterday. You can see clearly we were breaking down below these prior lows around 15.5, yet we came back up and closed at 15.6. Now, in my opinion, the new support level was yesterday's open at 15.383. Like the S&P 500, well, maybe unlike the S&P 500, we did finish higher yesterday on the NDX, but like the S&P, we still are in this downtrend. 5 straight days of lower highs and lower lows. And really, ever since we tested this top up here at about 16.6, 16.7, it's been pretty much down on the NASDAQ. So we did save. Can we get back through that 20-day EMA? I'm going to say no, but let's see. Market can do anything at once. Apple will be a big stock to watch. As I've written recently, I think Apple is subject to the possibility of a significant decline based on many of the things that I'm seeing. But we did hold on to the key short-term support. That was good. I would say gap support and the 50-day down at 165 is a level you really want to watch closely on Apple. I think if we break below that, we're probably going to be in a lot of issues, having a lot of issues on the NASDAQ. Yeah, I would just be careful on this move back up to get through the 20-day. Let's see if we can get through the 20-day. One thing that I saw the last time we moved up and moved down. You see how we moved down on big volume? The AD line went to a new high. So there was still accumulation in Apple. Here, what I'm seeing now is we just moved down to probably the lowest level on the AD line since back at the end of November. So probably 5 or 6 weeks. So that's what's making me think this reversal could be temporary. Maybe we hit that 20-day and then reverse back down. Just be careful. I think that's really the theme right now. Just be careful. Microsoft already has broken down below its double bottom. Went down, it did reverse at gap support and also this double top breakout that provides some support, and that's where Microsoft bounced. So now I think we're trending lower, but let's see if we can get through the 20-day. If we fail at the 20 or below the 20 and go back down and set a new low, then I think we're clearly in a downtrend short term. But that would be something I would be watching. Tesla had a really nice reversal yesterday. Off the downtrend, printed a piercing candle. Not quite bullish engulfing, but it's back up above 50% of that prior day candle body. That's what's referred to as a piercing candle. It's a wannabe bullish engulfing candle. Didn't quite make it. Bullish engulfing to me is more bullish, but this is still a bullish candle. I would expect a rally, at least in the short term. Maybe we get back up to about 1080, 1090. We'll see what happens there. That was the gap we saw a couple of days ago right here before the selling took us back below 1,000. One other positive I'll stress here on Tesla, though, relative to some of the others, is we had such a big move, came down, put in a left shoulder, neckline at 1,200. There's your head, right side of the neckline at 1,200, and then back down just below 1,000. I mean, this is almost a perfect symmetrical inverse head and shoulder pattern. So of all the big stocks that I'm looking at, the one that I think has the best pattern in play is Tesla. Now, of course, that would go away if we go down and fail to hold 900. You can't have an inverse head and shoulder pattern with the right shoulder going below the head. So that is what, and really I would want to hold where we did yesterday. I would even go out on a limb and say 980. If we go back down below 980, I'd be careful because we do have a really nice pattern here. Beautiful volume trends. Unlike Apple, you can see the AD line here on Tesla remaining pretty strong. All right, commodity outlook. I just wanted to go over a few of these commodities that I like to follow. Crude oil, as crude oil goes, so goes energy. Right now, we're trending higher on crude oil. Just watch that rising 20-day. We're getting a nice golden cross on the 20-day, which just crossed above the 50-day. So that's a little bit of a bullish signal there. I think overall, well, we still got the AD line still pretty strong here. Overall trend, you know, we were going down in November in energy, but an uptrend really consists of higher highs and higher lows, a series of higher highs and higher lows. Higher high, higher low, higher high, higher low. Some might say, well, what about this low? Why wasn't this the low you connected? Well, we never had a higher high, never broke out. So this is the key high, this is the key low until we get the breakout. So then this becomes the key high. This is not the key low because we don't go to a new high. This is the key low. This low is above this low. This high is above this high. Trend is still intact. There we go, another new high. This pullback stays above this pullback. So right now, we're still in an uptrend. Higher highs, higher lows. I think energy is going to go up in the first quarter and put in a new high. And then we'll go from there. I think at some point, inflation is going to peak out. So I think the next high on energy might be its last. And I don't think energy is going back down to zero or anything crazy like that. I just think it'll probably consolidate more after the next move higher. I do think we're going to go up, maybe even get to $90 a barrel. Outside chance at 100, but I'm going to say 90. And then we'll see what happens from there. Gold. Now, this is interesting. You know, when I talk about inflation and the fact that I don't believe it's going to stick around, this chart is one of the reasons why. If you go back, if you're a student of history, you know that when inflation becomes a real problem, gold not only goes higher and usually quite a bit higher, but it usually crushes the S&P 500. In other words, if inflation's a problem, you'd much rather be in gold than the S&P 500. But I want you to take a look at this. I'm going to go to a weekly chart here first. Let's look at a weekly chart. And this is gold. Gold looks like, pretty good. Nice move up, sideways consolidation. What's wrong, right? Well, I'm going to do this weekly chart, and I'm going to go back 25 years. I'm going to switch this from a candlestick chart to a line chart. And I don't really care about the volume. Let's just get the volume off. And then I'm going to do gold relative to the S&P 500. And let's update this. This is my problem. So, and actually, let's even go back further. Let's go 45 years. So back in the 70s, let's go back 50 years. So you can see 50 years probably better. So back in the 70s, if you looked at the inflation rate, it would look almost identical to this chart. The core inflation rate surged back in the mid 70s, pulled back temporarily, and surged again. So gold relative to the S&P 500, you can see that when inflation was surging, it was a great time to be in gold, and especially versus the S&P 500. That's not been the case. Here, look at what's going on. Look what happened in 2021. We've got surging inflation, and gold is doing nothing. On a relative basis, it's actually been going down. So is Wall Street really worried about inflation? Or have they just decided that gold is not a good hedge anymore against inflation? I think it's the former. I think Wall Street is saying, we're not buying gold. We don't care about gold. Now, I think gold in the first quarter could actually move higher and could actually outperform the S&P 500, not because of inflation, but because of fear of inflation. Big difference. Anyhow, that's kind of what I'm seeing there. I thought maybe we'd look at one more, which is the DBA. This is an ETF that tracks the agricultural area. I just see continuing movement to the upside. I see a nice trend higher. I think we go back up, not only challenge that recent high, but I think we'll break back out again on agricultural. So I think the first quarter will be kind to this area of the market. After that, I'd be a little more cautious because I do see inflation potentially coming back down. All right, earnings spotlight. ACCD, Accolade, you can see the move down, the bounce, and then another move down. They just reported yesterday. I was showing it was up slightly after earnings. Or actually, no, I'm showing it was down 4.5%. Let's take a quick look there. Yeah, wow, up 12%. So huge reversal. Maybe the earnings came out, or maybe there wasn't much of a reaction yesterday. But anyway, up 12%. So a big move, but I'm not sure I'd trust that move given the steep downtrend. I'll have to see how it trades after the gap up. As far as earnings go, coming up, ones that you're going to be interested in, I would think. JP Morgan comes out on Friday. AD line's been going down, so this is not really a stock that's been accumulated. So if it comes out with decent numbers and gaps up, let's see if it breaks out. If it doesn't break out, I'd be careful. I'd probably take my profits on that move. All right, real quick, the three you must see. With healthcare having the strongest rebound yesterday, I thought I'd pull up three healthcare stocks. Edwards Life Sciences, right at key support, right at the 50-day. I would expect to bounce here, have a tight stop in case it doesn't. Next up is UNH, United Health. Another one pulled back. There's a piercing candle right near support. Got to get through the 50 and that 20. If it can't, I would be careful because that AD line's not particularly strong. Last one, Danaher DHR, pulling back. AD line right here, moving back to about a 6-month low. I don't like that. So nice reversal. Maybe we get to the 20, but there I'd be careful. Anyway, that's it for me. Everybody have a great day. Appreciate you tuning in. I'll be back Wednesday for your next Trading Places Live at earningsbeats.com. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.